This is Bible School Radio, KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. On the web at kdkr.org and on all your devices with the Live 365 app. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, is the market decline over? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Hey, if you got a question for me, please go to the website at www.prudentmoney.com. Send it in, and I'll get you taken care of. If you need a little bit more than an email can provide, you can always go and reserve some time on my calendar, and I'll help you out that way. I just want to make sure that you know that prudentmoney.com is built to be a resource for you to help you with and get you information. That's all at the website, www.prudentmoney.com. Well, as the world turns, the old soap opera, that's what today's stock market action reminded me of. It just seems to go up and go down, and we're in a real period, I think you'd agree, of instability. And that's what typically happens, which is when you start to see a lot of this instability, is you're seeing a cycle change. That's one of the things that you could be seeing. We had an update today. Today was felt a lot better than yesterday, except for the end of the day. The S&P 500, just as an example, was about close to 2.5% up. Been going gangbusters all day long, and then lost about a 1.5% of that to finish right at about 1% return. And there's a reason for that, which we'll talk about in a second. Dow Jones Industrial Average was up about 0.75%. Expected a lot more out of the Dow Jones, and the Nasdaq was up about 1% as well. So you get a lot of this up and down type situation with the instability of the market. It's trying to figure out which way to go. So tomorrow we'll see which direction that it does go in. But when we're talking about watching the market, after it's been up all day, start to fall and start to sell towards the end, typically means that your average investor is selling and trying to get out. Because what ends up happening is that your average investor, of course, is invested in mutual funds. And what happens is that if I'm a mutual fund manager, I have all these sell orders that come in that I know I'm going to have to execute at the end of the day. So it may be that I don't have enough cash to fulfill those sell orders. So that means I have to sell investments. And if you can think of all the thousands upon thousands of mutual funds that could be in this situation, all selling at once, and they sell once they get an idea at the end of the day so that they can provide cash for these redemptions. So interesting times. We talked yesterday about being real careful to get too emotionally charged and getting, building up anxiety with what's going on. This is all part of it. And even though, you're seeing a big dramatic decline yesterday and then seeing it bounce back today only to really start to sell at the end of the day, and seeing a lot of that the market Wall Street calls it volatility. And I like to refer to it as an unstable market. It it creates the emotional roller coaster, which ends up forcing us to make decisions based on emotion and what you don't want to do. So I'll keep you posted if I think that things are risk. Obviously, there's a lot of risk in the market right now, but if I see to where I see a complete change of character, we'll definitely talk about it on the programs. And you can always, if you miss the program during the day, we do podcast the program at the end of the day every day, so you can go you can catch the day's show at your leisure, and you can go to whatever podcast platform that you like to go to, because I believe we're on all of them. So if you need more information, you can always go to prudentmoney.com. So what can you do to limit the anxiety? Well, this first tip might sound like a way that's going to increase more anxiety, but I do believe that if you stay in touch with your investments and don't ignore them, that you'll have a better feel for what's happening and will help you make good, prudent decisions versus emotional decisions. You'll hear this on financial TV, financial media quite a bit. Excuse me. And you'll hear, don't look at your investments, don't look at the statements, put the statements in the drawer, don't go looking to see on a daily basis. Of course, I even say that on a daily basis, don't go see. There's too much volatility that can create emotion. But the whole idea of here's your statement, and taking that statement, throwing it in a drawer, is not really a great way to go about investing. John Bogle, who was the creator of Vanguard Mutual Fund Company, and a guy that big name on Wall Street, started the Vanguard Mutual Fund Company back in the 70s, when mutual funds were he's a pioneer of the index fund, pretty much I would say the pioneer of the mutual fund period, but definitely the index fund. And he's no longer with us. He has passed away a couple of years, 2 or 3 years ago. But fortunately, I had the blessing of having him on the program a couple of times and interviewing him over a couple of books that he wrote. And he used to always say he'd be on CNBC and the market, this was during the financial crisis, and he would always say, just don't look at the news, don't listen to the news, don't pay attention. It's just all a bunch of noise. As much respect as I do have for him, because I do think he's a pioneer of so many things that we enjoy today as far as investing goes, I do disagree with that, because I think, once again, stay in touch with the amount of risk that you are taking. And that way, because here's the alternative to that, is that you don't take a look, you don't stay on top of what your investments are doing, and then you decide, well, one day I'm just going to look. And then it shocks you. You mean it's dropped that much? And you're surprised, and then you create emotion, and then you make emotional decisions, which we've talked about. You don't want to do that. But I believe, just like I believe with planning, that if you know where you are, whether you're behind, ahead, or wherever, it somehow reduces the stress a lot. It reduces the stress to at least know exactly where you are, and be able to make decisions accordingly. Number 2, consolidate your investments into one strategy. This is another way that you can help to limit the anxiety. If you've got 3 or 4 different investment accounts in different places, and you're doing different things with the investments, all that's going to do is create anxiety. However, if you move that those investments into a centralized account, because you can roll over old 401k plans, and I get a lot of emails about old 401k plans. What do I do with them? And this is a great opportunity to get organized and get under the ceiling of one risk level that really is designed to reflect what your risk level is. But consolidate your investments. I think that in 32 years of doing this, the worst that I've come across, I had someone come in and say they wanted to move money, and they had 12 or 13 accounts. It was quite a few. But it just, and the other thing too is that you kind of lose touch with your investments. So you want to make sure and get them consolidated. It's a great process to go through into one strategy. And I think that people today, as opposed to 25, 30 years ago, are a little bit better at consolidating than it was back years ago. The ultimate way to feel better, to limit the anxiety, reduce the anxiety, and I think this is the ultimate way to feel better, is to have a plan B put in place. A plan B is simply what you do in times of instability in the markets, and the ability to move and change risk levels. Now, Pop Culture Finance will refer to this as timing, that you're moving one investment to maybe a money market, or you're changing one type of investment to another type of investment. And they, in my mind, they confuse it with risk management. Timing, Pop Culture Finance always says timing doesn't work, and it's problematic. You can't pick the best time to get out and the best time to get in. Totally agree with you on that with Pop Culture Finance, and you can't time the market perfectly. More on that in a minute. This is Bob Brooks. We are up against a break. Stick around. I'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Our God is not a conglomeration of doctrines and dogmas for us to memorize. No, God is a person. We have the opportunity to know him, and he has revealed himself to us through his own Son, Jesus Christ.
Join Dr. David Jeremiah for his series in Ephesians, Belief That Behaves, next time on Turning Point.
Weekday mornings at 9 o'clock here on KDKR.
In 1 Corinthians, Paul reminds us to run the race of life to win the prize. Join me, Dr. Erwin Lutzer, for Running to Win. Be strengthened to finish your race with confidence.
Weekday mornings at 8 o'clock here on KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. We're talking about timing the market, and one of the few things I agree with Pop Culture Finance is that you can't time the market, and if you happen to time the market and get it right, we call that luck. And actually, it takes quite a bit of luck to be successful. But I also do believe that you set up yourself to be more fortunate and be in a situation to get lucky the more of the background work that you do, and that's the planning and the consolidating and the monitoring and all that kind of thing. So moving money, redoing your risk allocation, you're creating a plan B, totally different from timing. And I think it's one of the most important things that you can do. But you also need to have a strategy to get back to plan A. So let's say that you switch to plan B, and plan B for you is very conservatively based funds, maybe mix some bond funds in there and a lot of cash. Maybe that's what it is for you. Whatever, there's a lot of ways to do a plan B. Make sure that you're reviewing those investments. Don't just think just because I just set it into plan B, I'm going to leave it alone. You still want to review the investments, review the performance, how it's doing, how it's holding up risk-wise, and make sure that you have in the back of your mind, how am I going to switch out of a plan B to a plan A, because at some point you'll have to. So just a few things to think about and maybe implement to reduce that anxiety that the market has a tendency to create in times like this. Hey, let's talk a little bit about investment fraud. I haven't done that in a while, and I had a phone call today that made me think about, I think I'm going to talk a little bit about this because it's obviously still happening quite a bit, and I do believe that if you are aware of the red flags, then you can be then you're more likely to be able to avoid something like that happening. But look for the red flags. Fraud is all around. I'll give you a good example. And I usually the fraud, the stories of fraud, a lot of the time, not all the time, but a lot of the time, involve real estate. And I'll never forget this. This was local Dallas radio. This guy would go on Saturdays. He would kind of go from radio show to radio show to radio show, and they would interview him, and whoever the radio show was on. And he talked about this great real estate investment, and he talks about how you can make 10% on your money, and every year you have the ability to get your money out if you want to, or leave it in and let it continue to make 10%. And there's really no risk because all your investments are backed by real estate that's producing income. Now that sounds like a pretty good deal, right? The gentleman that I'm thinking about, the story, I believe he's still in jail, but he was not too long after he had been doing that for a while. He was I think it was the SEC showed up and raided his offices, and he ended up in jail. Excuse me, having a little bit of a hoarse throat today. But too good to be true. I mean, that's something we hear. It's very cliche. It's something that people say, but there's a lot of wisdom to that. That, if it's too good to be true, promising big guarantees, easy to get to your money. I mean, those are two of the bigger risks that you hear about. When you invest into something that's higher risk, it's not to where you can get to your money. You have to kind of commit to a longer term period. But if you don't have that, if you have the ability to get to it, a little too good to be true. Of course, big guaranteed returns, and we'll talk a little bit more about that here in a minute. That's always too good to be true. Because you got to remember, there is not such a thing as no risk, high return. One hallmark of a fraud is someone selling unregistered investments, and of course, the person selling the unregistered investments is also is an unregistered financial advisor to the public. That is breaking security laws on a lot of levels, and can get you in a lot of trouble. So if there's any question in your mind, go look up the individual that wants to sell you something on BrokerCheck, and I think it's .org. It's either .org or .com. I think it's .org. And you can look up the individual, and of course what you're wanting to see is a clean BrokerCheck record. But that can tell you everything that you need to know. If you can't find them, that's a red flag. And sometimes, to be fair, sometimes names are hard to find on BrokerCheck, but that is where the regulators do publish information regarding each advisor, what their background is, how long they've been in the business, and then if there's anything negative, that they're called disclosures, that the security laws require us as advisors to disclose. So you want to definitely check and make sure that they are registered, and you want, if there's any question about the investment being registered, you want to know that that is registered as well. But that is typically what you see when someone is peddling a fraudulent investment. It's almost always unregistered, and the advisor's almost always unregistered as well. Something that you also want to be careful about, and I want to be careful in saying this because I'm not saying that every scenario like this is a fraud. It's just that a lot of frauds have this characteristic, and it's called pooling accounts. When you go and you set up an account at a Fidelity, you set it up in your own individual individual account, and your money's not with anybody else's. It's all by itself, confined within one account. Reported that way, everything is based on that one account. When you're working with somebody who wants to pool your accounts, they have one account they put everybody's investment in, and it's amazing to me that regulators allow that to happen, but it's still very legal. There's a lot of compliance that has to be done with that. But that is where quite a few frauds that is characteristic of a lot of your fraudulent investment schemes. Here is a big one. Writing a check or transferring money to a bank account that is owned by a fraudster. Let me tell you the story of Bernie Madoff. I'm sure you've heard it before. Bernie Madoff pulled off the greatest Ponzi scheme in the history of the investment world. He was unfortunately very trusted by the Jewish community, Jewish charities of all kinds, brought hundreds of millions of dollars with his investment company. And when you're working with an advisor, you want to have walls of separation between you, them, and your money. And so you break it down this way. You typically have the firm, the investment firm. Then you have the broker-dealer, which monitors the investment firm. Then you have the clearinghouse or the custodian where the money is being held. And what you want to see is different ownerships. You want to be careful going to a advisor who owns the broker-dealer. Well, Bernie Madoff, even though they all had different names to the companies, owned the firm, he owned the broker-dealer, he owned the clearinghouse, and he owned the accounting firm that made the fraudulent investment statements. So if you were writing it, no matter where you wrote that check or wherever you transferred that money from was going, you might as well have been putting it in his personal bank account. So he did this for years until 2009 when he got busted. But brought a lot of heartbreak to the Jewish community and bankrupting charities. I mean, it was awful. But this guy successfully for, 30 years ran this Ponzi scheme, always had money to give to people when they asked for money, put out fraudulent statements, did the whole thing, and just ripped a lot of people off. But once again, you never want to go to somebody who owns the firm, has ownership in the broker-dealer. That's just a lot of risk. You want to be aware of that. And that's rare anymore that you see that. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.